My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramer. Other people are my friends. I'm just trying to help you make some money. My job is not just to entertain, but to educate, teach. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Today I went to a brand spanking new Norwegian cruise line holding ship for its inaugural launch right here in New York City. And all I can tell you is that once again, we are struggling as investors because we simply cannot predict human behavior. The cruise ship seemed filled with joyous people who were ecstatic about being on one of these things without masks. That had been the protocol. Now it's gone. They were itching to spend at the bars and the gambling tables. Of course, that's not a reason why people should buy or sell stocks, including this bummer of the day where the Dow shed 347 points. S&P lost 1.02%. NASDAQ declined 0.68%, giving back some of those big gains. But it's something you have to think about because so much of picking stocks comes down to gauging the public psyche, and that is inherently subjective. It's why I'm always trying to relate what you see in the real world with what you get in the stock market. So I see a full boat of people on a Norwegian cruise ship, and I think, you know what? That is bullish. Bullish for the company. But then I realize it's great for the economy, too. And you know what? That's bad for the stock market. Remember, the Federal Reserve is on a mission to slow the economy, and any sign of strength will cause them to raise interest rates more aggressively. Oh, let me put you another way. If you own the stock of Norwegian Cruise, you want it to do well, but you also want the rest of the travel industry, especially the other cruise lines, to do poorly, because that's the only way to avoid the wrath of the Fed and still make money on Norwegian. And look, that's the calculus in every industry. Last night, we received the terrific September sales numbers from Costco. They haven't had to roll back prices yet. They're just asking their suppliers to lower what they charge to reflect lower commodity costs. Costco is an inflation fighter. We want people to shop there because if how much they can save on food. When they get the suppliers down, they will take their prices down, too. Will the Fed include that in its thinking? Nah, that's too, as we say it in the business, too granular. We also own Costco for the Charitable Trust because its sales are so much better than everyone else's. And they're great at taking market share because of their low prices. But the Federal Reserve doesn't acknowledge the role of any single chain, even if that chain happens to have 119 million cardholders, most of them from the U.S. Again, we want Costco to do well, and we want the Fed to notice that they're helping in the fight against inflation. We don't want them to look at the other guys who are doing well, too, if they are doing well. But the Fed doesn't think like that. Nor can the Fed figure out the work-from-home movement. They'd know if they listened to AMD tonight, which reported a shortfall related to PC sales, most likely for the home. The stock's not getting hit too hard because it had already been cut in half. But most companies in the computing space figured the aggressive buying wouldn't last forever, and it didn't. It petered out. But they had made too many PCs in the interim. Now, I point this out because we are on the eve of the Labor Department's all-important non-farm payroll report, when we find out last month's unemployment rate and wage inflation. Now, we've had a good run this week going into the numbers. So today there were traders who locked in some gains because the job report's too hot. Well, it'll wreak havoc on your portfolio. But maybe the data, let's say it doesn't matter. When you listen to some Fed officials, it sounds like they feel compelled to keep bringing the pain no matter what.
The House of Pain.
It's astonishing to me that each Fed official is allowed to make their own statements. Feels like a linebacker coach or a special teams coach in the NFL who publicly diverges from the head coach. That's not allowed. These people have no idea how powerful their words are, and they keep popping off. Maybe they think it's part of their job, but I think part of their job should be to muzzle their views. There's no reason they should be out there talking. Worse, they base their statements solely on the aggregate data from the government, along with some local reports from their specific regions. They seem to have very little sense of the mercurial nature of the post-COVID consumer. They didn't in 2007.
They know nothing!
And I fear they don't know now. For example, we know that Costco is as strong as ever, but that may be a sign of a strapped consumer. We know the reservations for Norwegian at this point are better than they were in 2018 going into 2019. But is that a flush consumer who's spending like mad? or a stir-crazy consumer who finally feels safe taking a trip now that we're no longer worried about the pandemic? It's the psychology that's so hard to determine. How about air travel? We've been seeing, right? I mean, come on, every plane is full wherever we go, extremely full flights. Is that because the consumer's spending beyond their means? Or are there just so many events that didn't happen during the worst days of the pandemic? So people are simply catching up with their lives. It's confounding at every turn. The restaurants I want to go to are all packed. People are spending fortunes on liquor. I see it myself because my wife is in the high-end mezcal business. Price just doesn't even seem to be an object right now. It was always an object before. These days, people who don't have a lot of money don't blanch at a $15 cocktail. But when you talk to them, yes, anecdotal, they say they're just thrilled to go out, thrilled to be alive. Do we want interest rates lower to rein that in? Or can we just say, look, they're thrilled to be alive, and they're spending because, after a war, they realized they lived, they survived. We had some serious inflation after World War II, and it wasn't the end of the world. And it's more important, it did end. It could be the same thing with cars. There are myriad auto part makers who can't deliver all the components the car companies need. But if you took advantage of remote work to move from the city to the suburbs of the country, you need to buy a car to get around. You can't use public transit. That surge of demand for vehicles is unprecedented. Of course, if you simply look at the macro data, this looks like an overheated auto market that the Fed needs to act aggressively to cool down. I see these issues everywhere. So many people took big buyouts at the beginning of the pandemic. Why should they come back to work? We bought off a huge part of the workforce. They're enjoying their freedom. The Fed can entice them back to the office by making it too expensive for them to buy a house or a car with borrowed money. But if they don't want to come back, you can either train a machine to take their place or you have to pay up and educate new people. Of course, at a certain point, the people who were bought out will exhaust their savings and come back to work. But who knows what that point is? Will they run out of money if rates go to 5%? And I do want rates higher. I just don't know how high they should be, and I don't know when they'll come back. And that is the problem the Fed faces. If I were Jay Powell, I'd put together a team of behavioral psychologists to help them figure out how people behave after a war or a pandemic. The euphoria I saw today on the Norwegian cruise ship was almost eerie. The masks being off changed people. They're ready to do things that they wish they'd been doing before the pandemic. Before the pandemic, so they're changing their behavior. They don't care about higher rates. They have savings because they did nothing for 2 years. My biggest worry right now is that the aggregate data can't capture the nature of this one. It's all a lot of one-time only euphoria behavior. People who survived the war are not the same as they were before the war. They want to go out and spend like crazy because they lived. They want new things. They want a car. They want a better house. A year from now, there probably will be no euphoria. It'll be over. They'll have spent their excess savings. And that's exactly when interest rates will likely be at their max, because the 2-year Treasury simply can't measure the joy of people on a cruise without a mask. The data's inflated, but the 2-year 4.2% is a heartless beast, unaware of the person who stopped me on the ship and told me how great it was to be alive again. It measures some amorphous, heartless level of price that just may be too high because we feel different. Here's the bottom line. Sure, everything's inflated now, but so much of that's because we're coming out of the COVID era. All I can say to Jay Powell and company is that, yes, keep raising rates, but nothing lasts forever. Andrew in New York. Andrew.
Hi, big fan. Actually, my 13-year-old son is here, and he has the question, so I'm going to put him on. Thank you.
Excellent.
Hi, Mr. Cramer. This is Mo. Thank you for taking the time to talk to a 13-year-old Giants fan.
Well, 13-year-old, yes, Giants fan, no. But that's okay. Go ahead.
I have a couple of $1,000 to invest, and I was hoping for your opinion of what I should do with it. I was thinking of either inflation-adjusted bonds or an index fund. If you think an index fund is a good idea, in which sector? And should I wait until the market calms down?
No, you're 13 years old. You should be in the most aggressive index fund possible that has a lot of high risk, high growth, because you got your whole life to make back if you make a mistake. Certainly not bonds. Those are for much later. And I can tell you got horse sense because you put that idea of an index fund in your mix, but let's make it a high growth fund. That would be the best. And thank you for calling. And good luck with the Giants. They're 3-1, but to me, it's ephemeral. Let's go to Ricky. Google. Ricky in Texas. Ricky.
Booyah, amigo. Your fellow mezcal connoisseur started a position with Google Alphabet back in the stock split. I want to know, should I continue building on this position?
It's
Or
like-
is it time?
I think it's like Phosphoro, my wife's mezcal. I think it's a buy. I want to be there. I want to buy some. We have big for the Charitable Trust. I think we should be even bigger. And by the way, let me throw in Amazon. I'll give you a 2-for-1. How's that? All right. Inflation is everything now, and we know that. We want rate hikes. We want to tamp it. But so much of what's happening in inflation is just because we're coming out of the COVID era, and you got to incorporate that in your thinking. All I can say to J. Powell and Company is nothing lasts forever. Oh, man, tonight, Constellation struggled in today's tape, so is it time to take a sip of the beer and wine's Kingpin at a lower price? I'm thinking yes, but let's check with the CEO. Then, earlier we had a chance to go on board the brand new Norwegian Prima, as I mentioned. First-hand look at the latest of the cruise company's numbers, too. And don't miss my exclusive with the CEO. Oh, by the way, and Mercedes is on a mission to become maybe one of the most sustainable car companies on Earth. And I'm learning more about the pursuit for a clean future with the company's top brass. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.